Let's welcome on board Sandip Sabharwal as well and find out what he's making of the market texture right now. Sandip, hi, afternoon. It's almost like the market is believing that next RBI policy and you're surely going to see a rate cut. Is there a correlation? Should one also anticipate a rate easing by RBI?
So it looks highly unlikely that we are going to see a rate cut anytime soon. However, I think the scenario that's building in globally right now is that the rate hike cycle clearly seems to have ended. And once that happens, we'll see that the dollar index peaks out, flows start into emerging markets, etc. So I think that's the phenomena we see. On the flip side, in anticipation of all of this, we have already seen the market run up around 2,500 points almost in a straight line. So it calls for exercising some sort of caution at this stage because suddenly a lot of people were very bearish in October. Now I see everyone being bullish. So that becomes something we should be cautious of.
But Sandeep, then what do? You obviously will not put fresh money to work at these levels, but do you also profit take?
So holding some amount of cash is prudent in potentially sectors where the run up has been too swift or where someone has an overexposure and then wait for some corrections to allocate that. But the overall economic outlook is positive, so we can't go very hugely into cash. So maybe a 10-15% cash position could be potentially prudent. And then in between, opportunities will keep on coming up because all stocks don't correct at the same time. So sometimes some stocks have not moved. The market is ignoring that, and you can allocate to that.
Okay, point taken. But I also wanted to put the spotlight on the IT stocks because they are the ones which are firing away in the trading session. Nifty IT is, of course, sitting at 52-week high levels, the best that we have seen since April of 2022. A lot of reasons for the tailwinds. Of course, Nasdaq is one space which has been rallying, so a bit of a runoff. The interest rate cut will improve the DCF valuation, so that is what the support that these stocks are getting. Risk of recession also kind of reduces because they are talking about easing ahead of the curve. And then there was this study done by HFS talking about how the IT spends in 2024 are likely to inch up by around 9% as compared to the low single digit number that we had seen in 2023. Of course, Q3 is going to be muted, but then a lot of analysts believe that it's just not prudent to time the market. Perhaps we are towards the end of the bottom, so it's good time then to start accumulating. But if you look at the valuation wise comparison, Nifty IT is now trading at a forward valuation of almost 25 times, while the 5-year average is sub 23 times. So the valuations are not comfortable. And even if you look at the rest of the IT names, and they will come up for you on the screen, the valuation of the individual names are also quite significant in terms of the valuation of the individual names. But Sandeep, what's your view on IT? Would you concur with the view that it's time to start maybe adding in parts, or still stay away? There'll be better level coming when the Q3 weakness is reported in numbers.
I would say that a Q3 poor results are already expected by the. So to that extent, any poor result at that time should not affect these stocks so negatively. The key is what sort of revival cycle we see next year and what kind of growth comes in. So given the fact that in extremely negative situation, we've seen these stocks hold up. In fact, the mid caps have rallied substantially. So now we need growth of at least 10% or more for the industry for the overall stocks to do well, because it's not an under-owned sector. I think most funds own significant amount of IT stocks despite the downturn. So I think for people who don't own, they should start allocating. For people who have reasonable exposure, I don't think we should go overweight right now.
Okay, here's some interesting, data as we head into a brand new year. Let's also take a look at how India shopped online. And my colleague Ankita is here with the breakdown of a report coming in from Bain Capital.
Well, that's correct. Let's quickly look at how India is shopping in 2023, and it's a report by Bain and Company. Now, e-retail has been a disruptive force, in the global retail market. Now, the online first retailers, in fact, constitute 2/3 of the total sales generated by the top 10 global retailers, and there has been a threefold increase in that over the last decade. Now, COVID-19 had really accelerated the e-retail business, and that has largely remained steady over the years. Now, this year, we will examine it on 5 major themes that are going on in e-retail space in India. First is the long-term growth fundamentals, the shopper micro segments, the emerging business models focus on profitability, and the role that generative AI will be playing. Now, India's long-term growth fundamentals look absolutely robust. India's market is estimated to scale to $57 to $60 billion in 2023, adding almost $8 to $12 billion annually since the year 2020. Now, India's annual transacting e-retail shopper base is estimated to scale 230 to 250 million people in 2023. Over 100 million of these shoppers have been added just in the last 3 years. Now, diverse consumer micro segments have also been more salient if you look at it. Now, 7 out of 10 shoppers, reside in the tier 2 cities. A third of the shoppers come from Gen Z, and a third of the shoppers actually come from the lower income cohort group. Also catering to these segments, we saw the emergence of 4 e-tail models, the e-tail business models, which are quick commerce, hyper value commerce, inspiration led commerce, and fast fashion. Now, finally, the role of generative AI will fundamentally alter the e-retail experience. A series of high-impact use cases are emerging that will positively impact the shoppers and the sellers' journey. Now, the e-retailers are looking at technology, to disrupt basically 5 areas of shopping, which is discovery, seller enablement, target marketing, consumer support, and business efficiency. Now, the next chapter in India's e-retail growth looks very promising, definitely very, very exhilarating, enabled by generative AI, and the industry is likely to push these boundaries ahead.
We're putting that into perspective. So that's how India has shopped in 2023, but we are putting in perspective the trends that might be there in 2024 as well. But Naresh, coming to you, a couple of counters from the metal basket are actually doing quite well for themselves. SAIL is higher by 8%, Nalco is up 5%. Any name that you like from the metals pack?
So SAIL and Nalco have higher volatility, and they keep getting into derivative band in and out of it. So out of the metal names, I would go with Hindalco, which looks promising because the stock has been a slow and steady trend in the last 1.5 month, and has started crossing highs made last in 2022, and has been sustaining well. So I would expect Hindalco would be the first one which could actually go back and hit the highs made in 2022, which is closer to 600, 630 mark. So at current levels, as well as on dip, Hindalco is where there's a good risk reward.
Sandeep, just taking a leaf from what Ankita was flagging off in terms of, what the shopping trends are in India, and broaden that a little bit, when do you think the rural recovery will make a meaningful comeback? And would you say that that's a contra trend that we should play by, or do you think go with the writing on the wall, urban India, premiumization, those are the themes which are working well, so stick by with that?
There was an anticipation that we'll see a rural recovery going into the second half of this year. However, cropping patterns due to low soil moisture, as well as lesser income across the entire integrated scale, has led to rural demand continuing to be weak for now. So what do we look for next? So next will be now going into looking at the next monsoons and the impact of that. So I think rural recovery, I would say, is still somewhere.
Recovery is some time away, that's the word coming in. But one space which is coming under pressure today, as we flagged out, is insurance. Kunal, what's your view? Should one look at buying the dip that you're seeing on the likes of Max Financial, HDFC Life, SBI Life? I'm guessing the alpha is a bit low in these names, not a very,
beta.
Yeah, the beta rather is a bit low given the fact they're not very volatile. So what's the take?
Yeah, I think the beta is low, but these stocks are have already confirmed a breakout for themselves. So one of the characteristics which we look out for is that if the stocks give breakout for themselves on the medium term charts, on the long term charts, and if they're actually low to moderate beta, then we actually would want to ride the trend for these stocks and would probably try and participate or maybe add positions in case if these stocks go into a one-off phase of correction. So I think that's a classical sign that these stocks are trying to migrate to a higher level, and in that process, in case of these stocks, they give you some high priced up moves or in a short duration of time, then the beta tends to lower down when these stocks go into a correction phase. So I think that's a classical sign that you should be ideally looking to buy these stocks on dips. Now from the insurance pack, two of the stocks which we've been bullish on would continue to stay bullish would be HDFC Life as well as SBI Life. I think SBI Life predominantly has been one of the more stronger names, a V-shaped recovery for the stock price in the last I think 3 months or 4 months approximately after a sharp correction in the month of August. And HDFC Life has also been a very slow, gradual and consistent mover. So both of these stocks look attractive to me.
So the risk beta is low and hence the alpha generation in these names is also lower. But time now to go across to Anurag to get a sense as to what the story is and its implication. Anurag?
This is a major development in life insurance space. Insurance regulator IRDA has come up with a draft exposure draft related to the product regulation in life insurance sector, and which mentions the change in formula to calculate surrender value and surrender charges of life insurance product, non-par life insurance product. So as per the exposure draft, the surrender value will increase and surrender charges will decrease. So it will be beneficial for policyholder, but will impact the margins of life insurance companies in their non-par segment. Although this is an exposure draft, so final draft paper, final rules will be implemented after the consultation with all the stakeholders, and life insurance companies will also put forth their viewpoint related to this exposure draft. But indeed, it's a very big development as far as related to the life insurance space, where a formula to calculate the surrender value and surrender charges in non-par insurance product will change, and which will benefit the policy holders.
Intent is always for the common good of people, policyholders, and for the entire ecosystem. So a lot of actuarial calculations go behind it, and depending on the calculation on certain kind of products, not all products like that, certain kind of products. So there is a thought process going on, and it will be discussed, deliberated, and what will be the best solutions available, so that will be adopted. So these are the things. So it is now too premature at this stage to come to any conclusion on all these things. So it's an ongoing process, whether it is processes for claim settlement of maturity claims, death claims. So these are all that means.
So sir, this will be beneficial for the policy holders, because we see that in most of the time after 3 years, policy holder get the surrender value in a very less amount. So that it will impact the policy holder. The persistency rate in life insurance will go up, and the overall surrender value will increase.
What happens is whoever that means manages certain affairs, they take into account the views and benefits of all stakeholders. So, and policyholders' stake is definitely important because they are large number, and but at the same time, all stakeholders' views are taken into account, and accordingly decisions are taken. Okay. So it's an ongoing process. So for many things it happens like that.
So it's an exposure draft, and you will take consultation from all the stakeholders like insurance companies, like agents and policy holders, and by when it will get implemented, sir?
The process is there. So normally nobody should rush into processes. So the processes should go on, and it will take its own time, but and it normally happens usual time what it takes for all other things.